Welcome to CMR Interviews by Jason Shapiro. In today's episode, Jason interviews David Abramson from First New York on what prop trading firms are looking for. To learn more about Jason and David, check the episode notes in the description.
Hi, so this week we did a interview with David Abramson from First New York, which is one of, if not the largest prop firm and most successful prop firms in America. They've been around for a long time, and they are very successful. And David is the guy who really interviews and hires and does a lot of the monitoring for the people who trade money there. So the video, as it turned out, came out very grainy for whatever reason. So we're just going to put the audio up, but I would really suggest listening to this. I think there's a lot of value added here. Okay, thanks, and I hope everyone has a good week. Okay, hello. Today is February 20th, Tuesday, February 20th, 2024. I'm Jason Shapiro, crowdmarketreport.com. And today we're really lucky because we have David Abramson speaking with us. And David works at First New York Asset Management. Is that right?
Investment Advisors.
First New York Investment Advisors, which is, to my knowledge, at least one of the largest and oldest and most successful proprietary in the country. I manage money for these guys. I have been managing money for them. I don't know if we're going on 7 years or something like that already. 6 or 7 years.
The pandemic.
Yeah. I was before the pandemic.
Yeah.
Yeah. And I got to say that these guys are great. And I think people that know me know I don't say that about a lot of people. And I've had many discussions. David runs, and I hope I say this right, but he does the hiring of who is going to manage money for them and has done that for a long time, and therefore has seen God knows how many multiple hundreds, if not thousand, of traders come through there that he has interviewed, that he has hired, that he has not hired, that he has fired. And but he also monitors what they're doing P&L wise, risk wise, and is very involved with that. So he has a lot of experience in watching traders succeed and fail. And we have sat and had many about that very topic. And I always found it so interesting because I thought that his viewpoint is so good that I wanted to do an interview. So David, welcome.
Thank you, Jason.
Tell me where I was wrong. Tell me exactly what you do there and how long you've been doing it and how many traders and all that stuff.
I would say I have been doing it now for 7-8 years in this capacity. My title is head of trading, head of talent acquisition, but I do the things that you mentioned, plus a few other things I'd like to not admit on camera. At the end of the day, you're pretty accurate in regards to the thousands and thousands of portfolio managers, traders, PMs, analysts, one-trick ponies, all types of approaches, strategies, risk regimes, and markets. We see thousands of people a year. Can't say easily what we do like. Easier for me to tell you the things that we don't look for, but we'll get into that as we talk a little bit more about what we look for and how we do it. I essentially work with 2 other members of our investment committee, the chief risk officer of the firm and the CEO. And the 2 of us, with the help of 2 analysts on the risk team, are able to dive through most strategies and really peel back the proverbial onion to figure out most people's approach, the way they think, the markets need, the risk regimes they like, the places they struggle, and then we go from there.
Cool. And I'll just add as much analysis as they do in this. If I recall my interview, which I had taken about 1.5 years off of trading and went into sort of semi-retirement. And then when I decided to come back, I was interested in David and they gave me money. And I think my interview lasted about 3 minutes because he asked me how I trade. I said, I try to figure out what everybody else is doing. And I go the opposite. And he just laughed and said, okay, you're hired. And that's why we've gotten along ever since, because he got right away what I was saying. And the reason he got right away what I was saying, I like to believe, is because he's seen so many traders in trading. And he knows that the vast majority are going to not succeed for many reasons. And therefore, trying to make a market, so to speak, to those traders maybe will succeed. I think that was the thought process. But
So I'll tell you, it lasted a little bit more than 3 minutes.
Yeah.
But a good understanding of the way you run risk was really the sealer for me in regards to it's okay to think contrarian, but I've watched plenty of people with a contrarian opinion get carried out behind the proverbial woodshed because they don't understand risk parameters and how to control that contrarian tendency to want to pound your chest and say, I'm right, everybody else is wrong.
Correct. Correct. Which is why, well, first of all, I always say don't be contrarian price, be contrarian participation. Being contrarian price, everybody wants to be contrarian, but what is contrarian, right? And being contrarian price, I think you'll agree, will get you carried out. You know, you could have been contrarian price on the video for the last 12 months, and you just, and I'm sure you had guys that were trying to do that. And even that, I think, is fine, right? If that's what you want to be. But
Must
if
have
the thing's making a new high, then stop shorting it. You know what I mean?
just must have the risk discipline, must have a reason to be there, must have the discipline. $100 to make $4.
Right, exactly. Risk 4 to make 100.
Sounds
Good.
a little better to me.
Yeah, that's good. And I think that's exactly, as I always said, I think that's exactly the point with all of this, right? It's all about risk management, and it's all about risk return over time and understanding what that means, right?
Absolutely.
So what else can you tell me?
I would also tell you the single greatest risk mitigator for us is also the size of the allocations and the GMV. Very important to a little riskier strategy, little smaller allocation. And that's the single greatest risk mitigator on the planet, is to get smaller in size and deal with whatever conditions are presented and wait for your catalyst, wait for your event, wait for your strategy, your plan to play out, because you got to live to fight another day. We could talk about analogies all day long, but you gotta plan to open your doors tomorrow. Can't do that without risk discipline.
Be around long enough to get, is what we say.
Yeah, and better to be lucky than good.
And know when whatever it is that you do, that it doesn't, that particular thing doesn't always work.
Yeah.
Maybe it works sometimes, and when it's not working, mitigate your risk. My contrarian stuff, this has not been the year for that so far, right? We're into what, mid-February. This has not been the year for that. You can see it in all the numbers. Trend following is crushing it this year. All these strategies pretty much are crushing it this year. Trying to fade trends this year has just been a horrible, horrible way to try to live. I've been fortunate that I really haven't had signals to fade that many trends. So therefore, I haven't really lost, any money. And I think that that's fine. If I cannot lose money while trends and everything are ripping, then I will be around for when trends end and hopefully catch them and get that. And I think David, as an allocator, to me, understands that, which is so important for me, for my clients to understand. It's so easy. Everybody just wants to make money all the time. Just go make money. And that's kind of the first New York thing in a way. Is like, if you make money, they're good with you. Okay. He doesn't call me up and like, hey, why'd you have this trade on? That doesn't fit into what you thought. He doesn't, just make money. But we understand you will lose sometimes. Just keep that small. And that's good. It's almost like they look at it that easily to me.
It's a lot of common sense and sometimes overthought, but the truth of the matter is that there are times in the market you're going to make money. Your strategy is going to pan out, and those are the times that you should play and be involved. And there are times when it doesn't work, and those are the times they have to step away. One of the reasons why, as a firm, we don't run any outside capital is we don't want to feel the pressure to put money in the market or at risk when it shouldn't be there. And we feel the same way with our managers and our traders. Our thought process is use the capital when you should, not because you can. And when you should is what aligns with your risk thought process, what aligns with strategy, and what aligns with where your strength is. And if your strength isn't trading options because you have no idea about the K and what it means, and that the options market makers rule the world, you shouldn't be trading options. And that's the way we think about it. You have a skill set, use it. And one of my favorites is, we all remember, I'm a humongous sports guy with huge sports analogies, and we all remember when Michael Jordan went to play baseball, it really didn't work out that well. Stick with your skill set and your strategy and use your risk discipline. And over time, you'll make money, or maybe you should be in the business.
Amen to that. Amen to that. There's such a pressure all the time to just make money, right? In particular, I think well, with everybody, including the people who for you, because for the most part, they don't make money unless they make money. You know,
Correct.
they're getting paid a nice percentage of what they make,
Yeah,
right?
we don't pay when we allocate internally, externally, we're not payers of management fees. We don't want to pay people to put money in the market. We want to pay people money to take money out of the market and share it with them. So we're fond admirers of higher performance bonuses than most firms, and we're fond admirers of zero on a performance basis. I don't want to pay for someone's infrastructure. I don't want to pay for someone's poor real estate thought process or need to hire a team of analysts. I want to pay for alpha, and I'll share more of the profits with those that know how to generate it and keep it.
Yeah, and it's funny because when I came back, I took that thought process to build my company. All the people that I ended up taking money, I ran money for First New York probably for like 3 years before I then went and took outside money, and all my fee structure became zero. And because of that very idea, right? They don't get pissed at me if I'm not doing anything because they're not paying me any kind of monthly management fee, right? I'll get a higher back end if I make money, and I'm happy to do that. And my expenses are very low, so I can do that. But yeah, it doesn't pressure me. It's just one of those, you have to like surround yourself in your life to me to make sure that you can follow these rules. And that helps me a lot. I don't feel the pressure to have to trade because no one's calling me up being like, what the hell, we're 8%, a year and you haven't made a trade in 6 weeks or something. You know what I mean? It's like, okay, well, you're not paying me anything so, you're paying me to wait essentially for the low hanging fruit. And, recently, certainly the last 4 or 5 months, I've had the least amount of trades that I've ever had in my career, right? I mean, you see it, David, I'm barely trading. And what can I do? You know what I mean? If it's not there, it's not there,
The worst thing you could do is to force it.
right. So I don't feel the need to force it because I'm not getting paid a management fee. So I think that makes sense and I get it. And I kind of really, that was ingrained in my brain when I started managing money for you guys. Because it's just so true. It helps me psychologically as a trader to not take management fee.
I also think, and not all, so I don't want, this isn't a brush with a broad stroke comment, but I also think it's a little indicative of what someone's thought process is in the beginning of running or building a hedge fund or an asset management business. Are you in an asset gathering business or are you in the P&L business? And you tend to see those that think about construct things one way and those that think about asset gathering, build the org chart and hire all the PhDs. And it's a very different thought process. And it steers us in a couple of directions as well.
Yeah, I should have been in the asset gathering business.
Some very successful guys out there doing it, that's for sure.
I certainly took the wrong road, man. I actually have to freaking make money to make money. These guys just, they do nothing, right? They don't do nothing, but there's a lot of them out there that we've seen that don't do very much.
No, they're very good marketers.
Yeah, which I'm not. So there you go.
I'm a little bit of a talking head lately, a little different.
I'm a talking head, but I'm not a very good marketer. But unfortunately, I don't need to be because
Good for you.
I'm not looking to raise assets. I have enough assets. So
Yeah, neither are we. Please, no marketing. No, this isn't. That's not what we do. We don't want any customers. I don't want somebody calling me up, asking not long this or short that, or nope, thank you. We have a very, very good partnership internally with some really risk tolerant individuals, and they're all partners within the firm, and it's all attorney, and it's great conversations and a good understanding of making money, good smart trades, and losing money on good smart trades. It's helpful when that's, like you said, when you surround yourself with like-minded individuals, it's very helpful in trying to accomplish what you want to accomplish.
there's a couple things that I've always liked what you have talked about, and maybe you could expand on it. But this idea of like you like people that come in, and I know this is hard for somebody like right out of college or something like that, but you like people to come in and like they don't need to make money for a year or 2 years.
Yep.
Can you expand on that one a little bit?
Yeah, so one of the things that you said we've been around for a long time. This is coming up on 4 decades. And one of the ways that we've grown organically over the years is we have a very proven and tested assistant training program where we have partners in the firm that are essentially desk heads or not, we don't have any sector specific individuals, but there might be a couple of pillars within the domestic equity group and a couple within the international group. And they're very good at what they do. And they're invested in the firm, and they therefore bring on assistants, young people, read research and do work and understand charts and understand what makes markets move and how we operate, so that after a trader hits the screen, what happens and what goes on and why certain trades are held at certain prime brokers and certain asset classes are better serviced elsewhere, and just a general understanding for what goes on in the market. And she's training this person, and we pay them a salary and we offer them benefits, and we're not taking risk with this person, but we're trying to acclimate them to our thought process, which is event driven, catalyst type, shorter term swing trading. And this partner trains this person and takes them under their wing because they want to turn them into a producer and a partner in the firm, and also have them be another set of eyes and ears generating thoughts and markets and coming up with good risk reward trades, which is what we look for. And that program has produced 35, 40 additional partners over the years. And it's just fantastic because it creates a certain amount of camaraderie and endearment. And it also creates a little ownership to a central nervous system that you want to contribute to and you want to be a part of. And it's worked over the years where we've created and have partners that have been there since the late 80s, early 90s, that have been made multimillionaires through the partnership, through their own trading and the partnership involvement, which, we're fond admirers of sharing profits. That's for sure.
Hold on, I was thinking of the other one, and I know we can.
I'll say this out loud, Jason. Not to age myself, but I went through the training program. I worked for one of the partners in the firm right about the time when the internet was coming on. I actually had to leave the firm for the afternoon and go meet the cable guy to install the AOL dial-up so that he could get from home back in the day. And you've watched this business change over the years, and that, our assistants don't go home to meet the bellman anymore, but our assistants do dig in and listen to research reports and listen to conference calls and read 10Ks and to really understand what makes markets move and stocks move.
How many people would you say approximately at least are managing money for the firm right now? I know you have internal guys who only manage First, and then you have some external people like me who manage First New York money and possibly some other money.
So we have about 85, 90 internal proprietary allocations spanning asset classes from domestic equities to international equities to macro to commodities. And we have about 25 separately managed accounts, allocations to external managers like yourself that may run other pools of capital. They have their own compliance and infrastructure and operations, and either transact directly onto our balance sheet or send us an end of day file, and we share some profits in them. We're admirers of the emerging manager, those that are spinning out, doing their thing. We like good proven stories, and we like young entrepreneurs, and that's what we look for in the external world and the internal world.
How would you say it breaks up, if you could say approximately, in terms of if we're doing long short equity, how many people are doing whatever, One thing I love that he always told me, one of my favorite David Abramson is he tells me how like all these people come in here with these algo systems that are completely market neutral, long, short, and he just automatically tells them thanks, but no thanks.
We don't allocate enough capital for a market neutral, beta neutral, sector neutral, factor neutral. I'm trying to make a quarter of a basis point each month and make 4% a year and hope somebody levers me up in the background and I get to share in that too. That doesn't work for us. We tend to like best type of construct and a little bit more of a directional tilt. It doesn't, we don't like long only, we don't like short only, and we don't like market neutral, beta neutral, sector neutral, factor. There's a lot of market real estate in between those extremes, and that's what we tend to look for. And because we tend to share the humongous hedge funds that get to pass through all their expenses. We allocate a little bit smaller lines, and managers can do the math. Those know that they're a little bit capacity constrained. They may be a little niche in what they do, and that might be a better construct for them. And it depends. It's different strokes for different folks at our firm. If a manager like yourself wants to go on vacation for a week and shut it down, we say, God bless, good luck, have fun. And for us, it's very different. It's not like you mentioned before, the need to manage the capital. And therefore, it's a little bit of a different environment, a little bit of a different manager with a little bit of a different thought process. Now,
Yeah,
that's not to say that if that guy showed up with the market neutral, beta neutral, sector neutral, factor neutral strategy and it made a lot of money, that I wouldn't take a deeper dive. But most don't make a lot of money and need a lot of leverage, and we're not. That's not the way we do things.
I don't know how everything neutral all the time, quite frankly, can make a lot of money. I mean,
It's
in other
above.
words, I know you agree with this because you say it to me all the time. You got to take a bet at some point. You know
Yes.
what I mean? And it might be wrong, and that's fine. You always say we're in the risk management business, right? We're in the risk business. You've said that to me. You take a bet, and if it's wrong, then cut it. Lose a little bit. That's fine, right?
And live to fight another day.
Right. The other thing I have come to learn about your firm, which I also love, people come in and this happens, and the payout's pretty high over there, right? One of the highest out there, if not the highest out there. And they come in and they start doing the numbers in their head, and they just trade big, and they just want to make that quick buck. And what I have told people, as you know, that either introduced to the firm or that I knew that were joining the firm, is go slow, okay? Because these dudes take a long-term view of this, okay? When I started, for example, I hope I can talk about this, David, but when I started with First New York, listen, I had worked at a pretty large hedge fund for a number of years. I managed up to like $600 million at one point, okay? And when I left there, I had started my own firm, and I was managing like $250 million at my own firm, right? And then I took time off and found that I wanted to get back into it. And I spoke with David. They gave me a stop loss of about $200,000. And if we just back into the math, if my big drawdown is 5%, right? That's $4 million under management in my eyes, right? So I had to go from 600 million, 250 million to managing $4 million. And a lot of guys can't handle that, right? Because their egos are so big, right? Oh, I don't manage $4 million. But I didn't care, right? Because I just wanted to manage money. And what I learned was with David, as I believe is the exact right way to do it, if you show that you can make money, then there's money that they can then reallocate to you, right? You make money, they up it because now you're playing with house money, so to speak, right? And that's what I tell all the people, that when they join this firm and they manage money for this firm, I'm like, dude, whatever you're about to do, cut it in half or cut it in a third or cut it in a quarter, okay? And just go a year and show these guys that you can make, it doesn't matter how much, just show them that you can make money because they got plenty of assets to allocate. And once you become their friend and show them that you know what you're doing, then you can go and make money. And I think that's such an important concept for everybody, right? You're trading your own account, right? Go slow. I know you want to get rich this year. I know we all do. Okay. But go slow, take time, prove to yourself that you can make money, and then start to up the size.
Yeah, we tell everybody we don't expect anyone to pull a rabbit out of their hat in the first week, the first month, the first quarter, or the first year. You're right. The longer you have access to capital, the more good situations you can put yourself in and the more money you can make. And it's not about the elevated conversation about what your AUM is. It's about at the end of the year, what kind of money you make and how you make the money and do you keep the money? And for us, we tell everybody in the beginning exactly that one of the largest eating principles at the firm is the risk that we take in the beginning with someone. We're very, very disciplined when someone walks in the door that, listen, we're going to risk X with you. And until we make X, we're not stepping on the gas and we're not going to up the allocation. But our conversation is going to become commonsensical at that point. If it's working and you're making money, you're going to come and you're going to knock on somebody's door, myself or the chief risk officer. Hey, things are working. I'm seeing the ball. Can I have access to a little more capital? And you're going to ask the question, and the answer is going to be yes, sir, because it's working. And if it's not working, guess who's not knocking? And that's the way we think about it. So common sense, spin it around. I'm going to come to you, Jason, and say, hey, give me all of your capital on day one. We've never rubbed two nickels together. I've never made you a quarter. You have no idea how I think, how I act under pressure. Give me access to your balance sheet, and I need X. And I say, okay, here's X. And you say, no, I need 100 times X. I say, sorry, that doesn't work around here.
Yeah, I need 100 times X too. Don't we all need 100 times X?
Yeah, so do I.
Show me what you got first, and then we can talk.
Yep, I crack my jokes all the time, and you know me, I am a little bit of a wise ass. I say when we come and we sit down and it makes sense, I'm then moving to St. Louis because it's Missouri, and Missouri's the show me state. And show me why I should give you more capital, and show me that you know how to handle risk, and show me that you understand different risk regimes, and show me you understand your strengths and your weaknesses, and communicate with us and let us understand how need to micromanage and get involved in every trade. No way, no how. But I want to make sure you're thinking clearly. I want to make sure you're seeing the ball, and I want to make sure that our interests remain aligned.
It's just such a way to think about all of this stuff, whether you're allocating capital like David is, or whether you're just trading your own capital. It's such the right way to think about this stuff. And that's why they're so successful. You know what I mean?
You don't joke that it's common sense, but it's not that common.
Well, they say common sense is not that common, right?
Uncommon.
But like, again, I want to reiterate, we're talking to somebody here that it works. What they're doing works.
We're successful at what we do from trading. It's expensive to operate a firm with multiple PBs in this day and age, and multiple venues and staff and all the infrastructure to support it. But from a perspective, we do pretty well.
And I really believe it's because of these principles, these exact principles that you're speaking of, right? So learn from people that have been successful. Okay, these guys have been extremely successful, and this is, in my view, why. It's not because necessarily David has this magic ability to pick the greatest traders that have ever lived. Okay, he did find one, of course, but he doesn't have this magical ability to pick the greatest traders that ever lived. It doesn't really even exist, right? But he does have the ability to use this common sense to understand, right? Risk reward, right?
And I'll tell you, the rest of my team, the chief risk officer, is unbelievable when it comes to derivatives and understanding volatility and understanding people's understanding of those assets and the way they move and the way they think about them and the way they think about risk, which to us is, first, second, and third most important things. And we also have a really young on the team that is a phenomenal thinker and a coder and a quant, and to watch them eviscerate wannabe quants who a quant, I just play one on TV. It's fun at times and entertaining.
What do you do about the fact that, I always say this, but the vast majority of the people that walk in there looking for capital must be showing a track record, right? Nobody out there, I always say, like, nobody's out there with a negative track record going, give me capital, right?
Mm.
So everybody's out there that can show a positive, return. How do you decipher?
When we look at track records, we look for, and not a secret sauce, we look for those that make money in different markets and what happens in different months and what type of regimes. This was an ugly month. This was a positive month. How did they do this month? How did they do that month? We look at dailies. We look at daily volatility within portfolios to see how people act. We watch people sometimes take poor performance out of strategies. It's omitted from a strategy, oh, by error. And it's pretty easy to find some of these things if you're diligent and looking. It's we do little background checks on people, and some of the things that come up are pretty telling about where they are in life. And at the end of the day, everybody makes mistakes, everybody has hiccups, but it's for us, it's really about the person, about where they are in life, about how they're operating, about it's a total picture. And we have a really good crew that's really good at the different components of deciphering that.
What else can you tell everybody that will make them a better trader over time? Because you've seen so many people succeed and fail.
I tell you, it's funny that you say. I wrote it down a couple of notes, and for me, it's really about. Listen, I joke around with a lot of people, and I ask the question: and have a mirror in your house? Do you sit in front of it, and are you real with what you see there? Some people lie to themselves. It's like the gambler who goes to Vegas and always wins. We know that doesn't exist. We've all been there. The casinos aren't getting bigger and bigger because we always win.
Right.
And at the end of the day, it's those that are really real with what their strengths and weaknesses are. There are some people that are just really terrible at trading futures and get emotional about it. Like, no. And you have to take out the bad things and have to expand on the good things. And those that are honest and look at themselves and know who they are and know what they're good at and what they're poor at, it helps to make a very difficult business a little bit easier if you're candid with yourself and not that guy who says, every time I go to Vegas, I win. We also,
Go ahead.
from another perspective, it's, for us to are successful at what you do and how you do it, and do you like to talk about it? It's indicative of those that have success don't really talk about it. One, they don't really want to share their strategies. They don't really want to tell people what they're doing that's successful, and they're not braggarts. They're not talking about how much money they manage and talking about how much they make, and they keep life in check. They keep what they do in check, and they understand that this is a business. I'm not a gambler. Mama doesn't need a new pair of shoes. I'm running a business. And that's other things that are really important. You don't make 10,000 and buy the $1 million house. You make $1 million and buy the $100,000 house. Those are the things that make you make smart decisions. Running the business of life well helps running the business of trading well. And those are the things that we look for.
I'm getting chills on that one because I know that's things that I not only that I do, but I try to pound into people. I always say the only Ferrari I've ever had is what my partner bought me, which is right here.
That's better than the Ferrari I've never had.
Yeah.
I'll tell you this, Jay, not to tell tricks, not to tell anything, but emerging manager spins out of one of the big firms, has had a lot of economic success, building his own firm. It's dying for me to get on a train to go to Greenwich to see the really, really nice office East and meet his team of 5 analysts and meet his COO and meet his chief marketer, and he doesn't have $1 under management yet. I'm apprehensive to allocate to. But the guy who flies JetBlue from Dallas and has a geographical advantage down in the oil and gas industry and slept on his cousin's couch in Queens and rode the train in the morning to meet me is my guy. Because he's thinking about the fact that I want to get to the mountaintop. I'm not there yet, and I'm not portraying that I'm there. He walked in, he was sweating, he got lost. He mea culpa and said, I stayed in Queens on my cousin's couch. He thought it was a terrible thing. I fell in love. He still manages money for us today.
Yeah, that's that sounds like the story of my life. I mean, I have people tell me I have people comment to me all the time, about stuff like that. Why don't you drive a nicer car? Why don't you bigger house? Why, why don't you do this? Why don't you do that? You don't get it, man. You don't get it. And because of the way I came up too, right? Which is that I started with zero, blew out a few times, learned what that felt like. I learned those lessons. As we've talked about many times, I, I don't I don't spend money, man. I don't care how much I make. Like I'll go on vacation. I have a good year. Okay, I'll take my family and whatever. We'll fly business class or whatever and have a nice vacation. But other than that, I got no interest in buying a new house, buying a new car. I mean, once I have to buy a new car because I run my cars into the ground. But you're talking about every 10 years, I'll buy a new car. But I think it's so true, and it's all. Once did a video about that. Guys were making fun of the chair that I sit in because it had like a huge rip in it, and it was all messed up. And I never thought twice about it, right? And truthfully, part of my chair was like metal piece was coming out and digging into my ass. And I never thought guys were laughing at me and making fun of me. And I did a whole video about it. I was like, look, it's a mindset. Okay. It never even occurred to me to buy. Can I afford a new chair? I mean, what's a new chair cost? A couple $100? Fortunately, not what I can afford that. But it never even occurred to me. Right. And then I went and I did buy one after that. But the truth is, that's got to be the thought process. And people say it all the time. It's not about the money, it's about the process.
I have to tell you that one of the most successful traders in the firm runs our Aventura office. And he's international trader. He's phenomenal risk taker. He runs a very, very risk discipline approach and strategy, trains assistants all the times. Pandemic hits, the whole world moves to South Florida. I start meeting and interviewing people that have migrated down there and are looking for a home. And I send a few of them into the office to see him. And one of the guys comes back. He's like, whoa, I can't work in that office. I'm like, how come? He's like, busted microwave. The chairs are a little tattered. And if I could tell you how successful this guy is that runs that office, which I would never, it's remarkable to me that that was what was important to this guy, that I didn't have a leather couch in the foyer.
It's just not a trader. It's just not a trader. A trader could give a flying crap about any of that, right?
Correct.
I believe. And I came from the world. I didn't come from the world. I once got into the world of the large hedge fund and what do they call the things that they all wear? The vests, with the name of the firm on there and all that stuff. You know,
I was scared to put on a fleece today because I figured you were going to make a comment about it.
You got the FNY fleeces are going? I never.
I but I figured you were going to give me a hard time no matter what I was wearing.
Yeah. I was part of that world for a number of years, and again, why I love first of all the office of First New York in New York, which I go to once a year, twice a year. If I'm in New York, I come in, I say hi to you, I hang out a little bit, right? It's awesome, but it looks nothing like a hedge fund office. It's just one huge open floor with desks for people to sit at, computers for people to look at and trade off of, right? I mean, I think they have like maybe a little snack bar or something like that. But, there's none of this, like everybody gets, this is what we had at the hedge funds. Everybody gets to order free lunch every day. And there's this huge, like, spreads coming in all the time. And, it's just about that, right? It's about sit down here. Here's your desk. Here's a desk for you. Here's a computer, whatever you need.
And manufacture a living.
And make money, man. That's it. No one has to wear a suit, you know what I mean? No one has to wear it. And I've seen guys in there in shorts and a t-shirt. No one cares about any of that crap.
So shorts and a t-shirt, we tell them we should wear that to the office. We try
sorry.
to be a little business casual. You tend to come in and test the parameters, but you're a visitor. We're good with that. But that for us, the office is a pretty collegial environment with all kinds and all strategies and all approaches, and it's collaborative because there's a lot of partners that trade in the office that come in every day, that have come in through the pandemic, that still enjoy that. Listen, everybody misses a piece of research. Everybody doesn't read a chart, or everybody reads report and either maybe just pulls in the things that work for their thought process or their strategy. And everybody needs a little smack in the face every now and then about some thought process. And it's good to be in an environment where people give a shit about you and how you work and what comes out and your product and your production, because your success is their success. So it's a real collaborative environment that doesn't happen at a lot of places.
No, it's true. I don't go in there. I managed my around 6 or 7 years. I've been in there maybe 5 times. But I was in whenever that was, 6 months ago or something like that. I had a few hours to waste. I was in New York. I had something to do later, and I had a few hours, and they hooked me up with a computer, and I was able to sit to do my thing. And I did start talking to some of the people that were sitting around me who I've never met before. I don't know any of the people in there trading. I know 0 of them. And it's true. I sat there and spoke with a few of them, and super cool guys, super cool people, super open-minded to different ideas, some who were in the middle of struggling, some who were in the middle of doing well, but honest about that. How many guys do you meet that say that? You meet them the first time, how you doing? Oh man, it's been a shit year. I mean, I'm not checking his P&L. He can say what he wants to me. I'm not going over to you and saying, hey, how's this guy doing? You know what I mean? He can say whatever he wants to me. And that's what the one guy said. I'm having a shit year. Right off the bat, I respect him.
Yep.
Because no one says that. No one says that.
Nope. 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 Some guys always go to Vegas and win.
Yeah, I ain't one of them. I don't go to Vegas. I'm too cheap.
Me either. Me either. I have too many kids and too many bills.
No, that's right. That's right. Well, that's awesome, David. Any last thoughts?
Oh, that's it for me today. I enjoy having a conversation with you always. We'll always talk market metrics and the way we think and the way we feel. My absolute pleasure.
Awesome. Well, I appreciate your time, David, and I appreciate everything. You guys are you guys are great. I love it. I've never I don't want to say I've never had a better client, because I have some other clients that will listen to this, but you are one of the good ones. Let me put it to you that way. And there are people that I have not taken money from because I'm fortunate that I'm in a position where I can do that, but
that's a good one. That's the note we'll end on. Difficult business, difficult people in a difficult business.
It just gets in your head. They'll get in your head. This game is hard enough.
Correct.
I mean, and you think that it's not going to matter and blah, blah, blah. It freaking matters. When I had my CTA after I left my hedge fund, I had to take in whatever clients I could get, because I went in there and I had 5 people working for me in the office and the computers and the whole thing and all that stuff. And everybody who works for me wants to make $1 million a year. I had to take in whatever clients I could get. And that's why I closed it down and quit after 3 or 4 years, because I couldn't take it, man. These guys would call me up, you know what I mean? I have a bad week or whatever, and not even a bad week, just something within my expectations. They'd be calling me up, tell me I suck. What the hell are you doing? Blah, blah, blah. It doesn't work. It doesn't work. You know what I mean? It just doesn't work. And I learned that lesson.
Important for the right partners, the right risk partners. Important to understand what goes into it, how hard it is, and what the input and output has to be. It is very difficult, very difficult. Have a lot of respect for those that manage money and do it well.
Let's say that again. This game is extremely difficult.
I'm gonna officially end on this notice. We all know one of the most difficult businesses is the restaurant business, with a success rate in the low single digits. Our business success rate is not that far behind.
Low single digit sounds about right to me, which is why, as always, I suggest don't trade, fade. Find the other 98% and just take the opposite side. It's the easiest freaking way to make money to me, because they're all going to lose money. So anyway, we'll end on that note. David, as always, thank you so much. You're a gentleman and a scholar.
My pleasure, sir. Thanks for having me. Always enjoy it. Have a great night.
All right, we'll talk to you soon.
All right, bye-bye.
Subscribe to the Crowded Market Report YouTube channel for more CMR interviews and other content from Jason.